Welcome to the deep dive, where we crack open the most complex corporate filings and really try to deliver the essential intelligence you need. Today, we're looking at American Electric Power, AEP. We're using their playbook, specifically their latest SEC filing, as a kind of detailed map for the future of the U.S. energy grid. Yeah, our source is the October 2025 Form 10Q from AEP and its subsidiaries. It's a quarterly snapshot, covers Q3 2025. And remember, AEP is a large accelerated filer, huge company, about 535 million shares outstanding. So this document is packed.
Our mission today is pretty ambitious. We want to synthesize really three massive forces shaping this utility giant right now. First, there's this monumental capital investment plan they've got, think billions. Second, you've got intense pressure from regulation litigation, especially around legacy environmental stuff. Costs are piling up. And third, the impact of huge new energy demands, particularly from things like data centers. It's immediate and disruptive.
Absolutely. And this filing is it's essential because it really shows a company caught in the middle.
Yeah.
They're juggling the past cleanup costs, financing this present demand shock from data centers, and trying to build the grid for the 2030s all at once. The financial tension is just palpable throughout the document. You can really see it when you look at how they're performing, like right now.
Okay, let's start there then. That Q3 2025 snapshot. So AEP's reported GAAP earnings for the quarter ending September 30th were $959.6 million, which, interestingly, is exactly the same as Q3 2024. On the surface, that looks stable.
Right. Stable earnings. But that stability hides a pretty seismic shift underneath, especially when you look at who is actually buying the power.
Yeah, the filing is really clear on this. It explicitly points to new data processor loads as the main driver for increases in commercial sales volume. So data centers are fueling that commercial growth.
And we need to be clear, this isn't just like normal commercial growth. Data centers have this unique profile. They consume massive amounts of power. It's very concentrated. And crucially, it has to be absolutely stable 2047. That kind of customer, it just completely changes the planning game for a utility.
Right. And you see the other side of that coin, too. The filing notes counter trends, like weather normalized residential sales. They're moderating. Energy efficiency, inflation are hitting that. And industrial sales growth is pretty slow, too, likely impacted by higher interest rates, tariffs, that sort of thing.
So the old reliable customer base is flattening out, maybe even declining a bit, while this new megaload customer base is just exploding.
And what's fascinating, as you implied, is how this shift in who's buying the power dictates where the money has to go.
Exactly. It forces them to accelerate their capital expenditures, their CapEx. You can't just wait around and build slowly when you have this immediate massive demand for super reliable power. You need high-capacity transmission lines, you need dependable generation, and you need it, well, practically now.
Okay, so that brings us to the price tag for this accelerated transformation. And yeah, this is where the numbers get really big. AEP is forecasting $11.9 billion in capital spending just for 2025.
$11.9 billion just for this year.
Yeah, and that's just the start. The projection for the next 5 years, so 2026 through 2030, it's a colossal $72 billion.
$72 billion. That's not routine maintenance spending. That's building a fundamentally different grid.
The filing spells out where it's going to. It's very targeted. Transmission infrastructure, obviously, new generation resources, and they explicitly say it's to support existing and forecasted large load increases.
And of course, distribution system reliability gets funding too. Can't forget that.
So if you're AEP, the big question becomes, how on earth do you finance $72 billion, especially while you're also dealing with the costs of retiring old plants and cleaning up decades of legacy environmental issues?
Yeah, it requires some pretty aggressive financial engineering. And you need rapid resource acquisition. We're seeing that play out right now, actually.
We can see that acquisition strategy happening through their subsidiaries, right? Like Public Service Company of Oklahoma, PSO. They snapped up some major generation assets back in Q2 2025.
Across the spectrum, too.
They got the Pixley Solar Energy Facility in Kansas that came online in May 25, and the Flatridge Fourth Wind Energy Facility, also Kansas, online in June 25. But crucially, they also acquired Green Country Energy, LLC. That's a combined cycle natural gas plant in Oklahoma.
And acquiring that gas plant is really key. It speaks volumes about their strategy. When you're serving data centers that absolutely cannot tolerate power interruptions, you need that reliable quick start power. Something to back up the influx of renewables, which are great, but intermittent. It shows their hybrid approach. Lean into the clean transition, definitely, but make sure you have firm capacity for these massive new loads.
Okay, let's look closer at that future energy mix then. They've got a pipeline. Currently, AEP has approved renewable projects totaling about 2,885 megawatts across various subsidiaries. APCO, I&M, SWEPCO, PSO, they're all involved.
Almost 3 gigawatts of approved renewables. That's significant.
Okay.
But again, notice the natural gas piece running in parallel. It's critical for their stability plan, seems like. Look at SWEPCO, for example. They're seeking regulatory approval, a CCN, for 2 pretty big gas projects. One is building a brand new 450 megawatt plant, the Hullsville natural gas plant, and the other is converting the old Welsh plant, units 1 and 3, to natural gas. That conversion alone is estimated around $723 million. They're aiming for service between 2027 and 2028.
Wow, $723 million just for the conversion. And PSO is also going for a new 450 mW gas turbine at an existing site, planning for it by 2029.
Yeah, so they're clearly building and converting gas alongside the renewables. It's a dual track.
And if we look even further out, the pipeline for future power through requests for proposals, RFPs, is huge. AEP has active RFPs seeking a total of 7,700 megawatts right now.
7.7 gigawatts they're shopping for.
And just one subsidiary, I&M, has an RFP out for up to 4,000 megawatts. They're looking for everything. Intermittent, like wind and solar, non-intermittent, even emerging tech.
So they're casting a wide net to fill that massive $72 billion investment plan we talked about.
And spending that kind of money inevitably brings us right back to regulation, doesn't it?
Absolutely.
Yeah.
A utility can't commit to $72 billion without some level of certainty that they can actually recover those costs from ratepayers eventually. And the filing shows AEP and its subsidiaries are, well, they're moving aggressively to de-risk these massive investments, especially the ones driven by those large load customers like data centers.
This is where some recent legislative action, particularly in Texas, gets really interesting. AEP subsidiaries are filing new tariffs specifically aimed at data centers and other huge power users. Basically, they want higher minimum demand charges.
Making sure those customers pay their fair share for the infrastructure needed just to serve them. Makes sense.
And Texas is actually putting this into law. Senate Bill 6, which took effect in June 2025, it mandates that large load customers in ECOT pay a reasonable share of transmission costs.
That's a direct legislative response to the data center boom, no question. But there's maybe an even more important financial tool they're using in Texas now, thanks to another bill.
You mean House Bill 5247, the one about the UTM?
Exactly. The Unified Tracking Mechanism, AEP Texas, is leveraging this new law. And it's a pretty big deal for their finances.
Okay, break that down. What does the UTM actually let them do?
Well, traditionally, a utility spends money on big projects, like transmission lines, then waits, sometimes years, for a formal rate case to get approval to start recovering that money. There's a lag and risk. The UTM basically allows AEP Texas to get annual interim rate adjustments. They can start recovering the costs of those transmission and distribution investments much, much faster.
Ah, so it speeds up the payback for building the new grid infrastructure?
Precisely. The filing says through September 2025, AEP Texas had already deferred, meaning set aside for recovery, $39 million using this UTM. It significantly de-risks that huge CapEx number by shortening the time until they get paid back.
Okay, so they're using the UTM to accelerate cost recovery for the new grid build-out. But they're also using another financial tool, securitization, to handle the costs of the old grid, right?
Yes, that's the other side of the financial engineering coin. Securitization is critical for dealing with legacy costs. Essentially, they take these past costs, like the remaining book value of old power plants they're retiring, or big costs from storm recovery, and they bundle them up. Then they issue bonds backed by these costs. Ratepayers pay off these bonds over a long time, maybe 10, 15, 20 years.
And what does that do for AEP now?
It cleans up their balance sheet almost immediately. It gets those old liabilities off the books, which frees up financial capacity. It makes it easier for them to borrow money for that massive $72 billion future investment. They're basically monetizing their past burdens.
And the amounts they're seeking to securitize are not small. In Virginia, APCO filed for $1.4 billion in bonds. Covers undepreciated balances at the Amos and Mountaineer plants, plus deferred storm costs.
In West Virginia is even bigger. APCO and WPC submitted a revised request there for about $2.5 billion. Again, covering assets like the Amos, Mitchell, and Mountaineer plants, legacy costs.
And Kentucky Power, KPCO, they already issued bonds back in June 2025. About $478 million to recover $500 million in regulatory assets, including plant retirement and storm costs.
So you see how central this strategy is. They're using securitization across multiple states. It's all about clearing out the old financial baggage to make room for the new debt needed for the $72 billion plan, largely driven by those data centers.
This focus on managing legacy costs, it leads us straight into probably the single biggest legacy cost item mentioned in the filing: environmental cleanup.
Yeah, the coal ash issue.
Right. Let's talk about that elephant in the room. The cost of environmental compliance, specifically the EPA's revised CCR rule, that's coal combustion residuals, or coal ash. This rule seems to have triggered a really immediate and pretty monumental financial hit.
It has. The revised rule, they call it the legacy CCR rule, it mandates stricter requirements for handling coal ash ponds, especially around closing them properly, often closure in place, and importantly, long-term groundwater monitoring. Based just on AEP's initial estimates of what it will take to comply, they recorded a staggering $674 million increase in their asset retirement obligation, their ARO.
Okay, $674 million increase. For listeners maybe not familiar, the ARO, the asset retirement obligation, that's basically the liability a company carries on its books for the future cost of dismantling assets or cleaning up sites, like these coal ash ponds.
Exactly. So adding over two-thirds of $1 billion to that future liability in one go, that's a massive balance sheet adjustment. It's a profound long-term cost.
And the filing sounds a bit uncertain about the final number too, right?
Very much so.
Yeah.
Management says they're still evaluating exactly what compliance will entail and cost. But the critical point I make, and this connects back to our earlier discussion, is that cost recovery for this massive cleanup must be sought through regulated rates.
So just like the old plant costs and the storm damage, this huge environmental cleanup bill eventually lands in future rate cases or potentially more securitization requests.
That's the mechanism.
Wow.
It becomes another regulatory asset they need to recover over time.
It's really something to see this huge legacy cleanup burden sitting right alongside all the talk about forward-looking innovation and dealing with new global risks. The filing mentions things like inflation, tariffs, geopolitical disruptions, saying they're extending lead times and pushing up costs for materials, labor, fuel, the basic building blocks.
Yeah, those global supply chain and economic pressures are definitely a factor in executing that $72 billion plan on time and on budget.
They also specifically mentioned the signing of the One Big Beautiful Bill Act, OBBBA, in July 2025. Seems like that's shaking up the tax credit landscape for renewables.
It is. It modifies and actually accelerates the phase-out of some key technology-neutral tax credits, the PTCs and ITCs. And interestingly, it adds new restrictions against foreign ownership in some energy projects.
So the regulatory complexity isn't just at the state level with REIT cases, it's hitting them from the federal and even international trade angles, too.
Right. Yet, despite all those headwinds and legacy costs, they are making some pretty significant bets on technology to help manage the immediate future.
Like the AI investment.
Yeah,
Yeah.
AEP put $100 million into Gigawatt AI Inc. back in August 2025. Got a 10% equity stake. And the filing is explicit. This is about using AI to optimize utility operations and infrastructure. You can easily see how that could help manage, say, the complex power flows from integrating lots of renewables or predicting demand from those data centers more accurately.
Makes sense. And then there's the fuel cell investment. That seemed quite targeted.
Extremely targeted. AEP signed a purchase agreement for 100 megawatts of solid oxide fuel cells, and they have an option for up to a gigawatt total. The filing directly states this is to support large customers like data centers, while grid enhancements are still underway.
So it's like a bridging solution, providing clean, reliable power on-site or nearby for these demanding customers until the massive grid upgrades, part of that $72 billion plan, are actually built and operational.
That's exactly how it reads. It's a way to meet that intense, immediate need without waiting years for new transmission lines. It's a fascinating example of innovating under pressure.
So that really paints the picture, doesn't it? You've got these regulatory tools like the UTM and securitization trying to de-risk this enormous $72 billion capital plan.
Right, while they're aggressively pursuing renewables, but backing them up with significant natural gas investment for reliability.
And they're placing bets on AI for optimization, fuel cells for immediate power needs.
And all the while still grappling with this huge $674 million initial jump in liability just for cleaning up old coal ash ponds.
Yeah.
It's really a tightrope walk.
So let's bring it back. What does all this complexity mean for you, the listener, whether you're just paying an electricity bill or actively watching the energy markets?
Well, we've seen AEP as executing this truly massive $72 billion capital investment. It's largely driven by this extraordinary demand shock, primarily from data centers, and they're financing this while simultaneously navigating these high-stakes regulatory battles over energy prices and dealing with enormous legacy cleanup costs.
I think it fundamentally underscores just how complex utility finance is today. It's not simple. The transition to a cleaner grid, it isn't just about funding wind and solar projects with new debt. It's also about financially engineering the liabilities inherited from the past century of energy production. Costs for everything, storm recovery, retiring old plants, that massive coal ash cleanup, they're all being managed through rate filings, regulatory mechanisms like the UTM, and increasingly these sophisticated securitization bonds just to free up capital. Yeah, this Q3 filing really confirms it. The energy transition isn't just happening out in fields with solar panels or wind turbines. It's being codified, documented, and argued over in rate case filings, in the creation of regulatory assets, and in these complex securitized debt deals. So here's a final thought for you to consider, building on everything we've discussed from this AEP filing. Think about that staggering $674 million initial increase in the asset retirement obligation just for coal ash compliance. Remember, that's a deferred liability. Utilities like AEP have to manage it, likely by seeking rate recovery from customers over many years. So, does the cost of cleaning up our legacy energy infrastructure, the coal ash ponds, the old plants, actually pose a greater, or maybe just a different kind of threat to long-term financial stability and future electricity rates than even the monumental cost of building the new $72 billion grid?
It's a tough question. Is the burden of the past potentially heavier than the investment in the future?
Something for you to mull over as you watch the energy markets
Right.
and maybe your next utility bill.